Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is December 2nd, Saturday, December 2nd, 2023. How you doing? Appreciate you coming by and watching my weekend review podcast. I hope you had a good trading week. Boy, the market's really been strong, hasn't it? Just unbelievable. And in the podcast today, what we are going to do, this is the format. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back and we're going to take a look at all the trades I made last week, both on the daily time frames and the weekly time frames. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the strategy was, and most importantly, how I am going to manage the trade going forward, whether to the upside or to the downside. It's very important, everyone, in trading that you're very patient. You wait for a good setup that gives you a good risk to reward ratio, and you have to have a process so that you know exactly what you're going to do regardless of what the market is doing. Just in general, you want to look for some kind of support that gets rejected that gives you a good risk to reward ratio. You want a position size based upon the current market volatility, and also based upon your total trading capital. And I'll go through and I'll show you how we do those numbers later in the podcast. I myself always have an emergency stop, and then I have an end of day stop with a good risk to reward ratio. I have certain levels above my entry that if it reaches, then I tighten up my stop. I go into what's called trailing stop mode. I always take partial profits each day if the market goes up a certain amount, which I will also get into with you. But the key is you need a process. You need to have rules so that you say, okay, if it does this, then I'm going to do that. If it does that, then I'm going to do this. But the really big picture, the key with trading is that look for a level that is a key support level that is rejected, position size correctly, and if you're wrong, get out quickly. If you're right, be patient and have a process that keeps you in the trade so that you know what to do. And one of the worst things you can ever do is just not know what to do with the trade. Oh, it's up. Should I just take it? Or if it's down, oh, I don't know. Should I hold it? You need to have process and rule-based trading so that you know what to do. It makes your life so much easier, and it's such a more holistic way to trade. But it all comes down to risk to reward ratio, and it all comes down to being very patient with your winners and very impatient with your losers. You'll see today in the positions that I have. I mean, it will be striking. When I'm right, I stay in. When I'm wrong, I am out quickly. And I had one that was wrong this week, and I'm out quickly. I'm not going to stick around and just hope and hope and hope that it goes my way. But when you're in a winning trade, that's when you have to be patient. When you're in a losing trade, that is when you have to be impatient. And most traders, unfortunately, do the opposite. So we're going to look at my trades, when I entered, why I entered, what the strategy was, what the setup was, and then how I'm managing them going forward, both on the daily and the weekly charts. After that, I'm going to do a little bit about trader psychology. Always the most important skill in trading is psychological. It's following your plan. And if you don't have a plan, get a plan. I do teach private one-on-one lessons in the evening time via Skype. It's a 15-hour course I have been teaching for many years. I have taught people from all over the world, from absolute beginners all the way up to seasoned hedge fund managers and everywhere in between. And if you would like to learn good trading principles, if you would like to learn a process that you will know exactly what to do at all times with your trades, I offer that course. My email is in the link of this YouTube video. Just go ahead and send me an email. We can get the conversation started. But it's a great course. And like I said, I've taught people from all over the world. And if you really want to learn how to trade correctly, um, every aspect of trading, that's what I teach in my course. So send me an email. We can get started talking, and I know you're going to be glad that you did. All right. So after trader psychology, I have gone down through my watch list, both on the daily time frames and the weekly time frames, and I have identified some trades that I am looking for next week, both daily and weekly. And I got to tell you, I don't think there's ever been a time in history that I have had so many short potential trades. And, the market, of course, is having this kind of melt up here. And people would say, oh, you don't want to short into that. Well, that's true. You don't want to unless you have a signal. And there are plenty of signals to the short side that I'm going to discuss with you both on the daily and the weeklies. They're not there yet. If they were there, I would have most likely already taken the trade. So you have to be patient, identify those levels that you want to enter long or short, and wait for them to get there. That's why I like doing this on the weekend, because very calmly I can go through my watch list and go, oh, this is a potential, but it's not there yet to the short side. This is a potential to the long side, but it's not there yet. So I do have some longs as well, but yeah, the majority of these potential setups today are going to be to the short side. And they're not there yet. So if they do get there I will definitely consider taking them. And I'm short right now, actually, as well. And we'll get into that when I show you. All right. So I hope that this is going to be helpful for you today to watch and see how I'm managing these trades and what we're looking for next week. And if, as we're going through it, if you find it helpful and valuable, I would appreciate it if you could hit the thumbs up button. It really does help to build the channel, kind of lets YouTube know that there's some valuable content here. So as we're going through, if you find something helpful, if you could just hit that thumbs up button, I would certainly appreciate it. All right, so let's run the U.S. legal disclaimer. I'll be back in about 48 seconds, 42 seconds, something like that, and we will get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, here we go. Let's get started on the dailies. This is Caterpillar, CAT, and I did take this trade all the way back here on the 1st of November. Now, why did I take this trade? So I always like to look for a confluence and a combination of indicators lining up. One setup, one indicator is fine, and it's legitimate to take, but I have found over my 28 years of trading, if you wait for a combination of indicators to line up, the chances of you having a profitable trade are much better. So why did I take this trade? Well, for two reasons. There were two confluences of signals. Signal number one, you see the orange line here. This is the 300-day moving average. And on the day that I purchased it, it closed back above the 300. You can see the previous day closed below, then we closed above. That's legitimate. Just on its own, it's legitimate. But at the same time, here's an RSI. We went under 30, over 30. That is also a legitimate entry signal. But the two of them together make the trade even sweeter. And so as I enter here with the close under, close over the 300, the under 30, over 30, I'll take you through the process. So I see the entry and I go, okay, now the question is, how many shares do you buy? Well, that's a function of the amount of money in your account. So let's just use a hypothetical $100,000 account. $100,000 times 1% obviously is $1,000. If you had a $50,000 trading account, it'd be 500. If you had $1 million trading account, it would be 10,000. So I like to use 1% of total capital, $1,000. Then I divide it by the value of the 2 ATR. ATR means average true range. This is 2 times the average true range. So in this case right now it's 981 divided by 981. It would tell me to buy 101.9 shares, or just round up to 102 shares. So that's the correct amount of shares to buy based upon the current market volatility of the last 20 days. So I see my signal under 30, over 30, under 300, over 300. I buy 102 shares. Now, first thing I do is I place my emergency stop exactly that 981 below. This is the red line. So therefore, if I have 102 shares and it moves all the way back down to my emergency stop, I've lost $1,000, right? Or 1% of my account. Not fun, but you can always recover from that. So the first thing I do after I identify the signals, place my emergency stop, I see the signals, I place my emergency stop 2 ATRs below. Now I use 2 stops, emergency stop, what I just talked about, and then end of day stop. And 95% of your trades, if you have losing trades, will be end of day stops, not emergency stops. The emergency stops only happen about 5% of the time. The other 95% is you're just going to have a close back under your end of day stop. So this is such a great example here in trading of a good risk to reward ratio. I have my signals, under 30, over 30, under 300, close over 300. If in the future, if we had closed even 1 penny under this 300-day moving average, I simply would have gotten out of the trade. That's it, for a very, very small loss. Yes, it is possible that it could have gone down here, but we've already factored that in. If it did get down there, I would maximum only lose 1%. Okay, so here's the 2 stops, the emergency stop and then the end of day stop. Now, after I enter, I always place a level 1.5 ATRs above my entry. That's my trailing stop level. Emergency stop is 2 ATRs below. Trailing stop level is 1.5 ATRs above. And if we ever get there, then I go into what's called trailing stop mode, which means in the future, if I have a close below a previous bar's low, I will get out of half. It's a precautionary measure. Now, last but not least, everything I've talked to you about, the position sizing, the end of day stops, the emergency stops, the trailing stop levels, these are all defensive moves. But I like to incorporate offense into my trading as well. And how do I do that? I take a partial profit if the price moves up 0.45 ATRs from the previous bar's close, and I sell 10% of my position at that profit target. So here, I'm still in the trade, 256.76. So 256.76 is the most recent closing price. Now I look to my 0.45 ATR value. Right now it's 221. So I take 256.76 plus 221. My first profit target on Monday is 258.97. Then I take my first profit target, 258.97. I add the 0.45 to it again. My second profit target's 261.18. Take my second profit target, add it again, 221. That will be my third profit target on Monday. I don't know if I'm going to get there, but at each profit target, each of the 3 profit targets, I would take off 10% of the remaining position. All right, so that's kind of the overall setup of how I'm doing things. So let's see how the trade played out. Under 30, over 30, under 300, over 300. I know my emergency stop. I know my end of day stop. Here's my trailing stop level. Next day, moved up, hit a profit target. So already I have taken off 10%, reduced my position size, reduced my overall risk, and locked in some profits that the market can't take away from me. Next day, moves up again, took some more profits, hit 1 profit target, and I got to trailing stop level, which means now in the future, if I have a close below a previous bar's low, I will get out of half. Didn't happen the next day. This day, unfortunately, I got out of half, but that's just because my rules tell me to do it. And I did lock in a profit of 1.3, half of the remaining position of 1.31%. Still a profit. Next few days kind of moved sideways, not a lot. Then we moved up again, more profit targets, move up again, more profit targets, moved up again, more profit targets, moved up again, more profit targets. Then we had a bit of a pullback, kind of some consolidation. And then, of course, on Friday, big day up, hit another profit target. So we are at 60.16 RSI. I haven't really done anything in here because once I sell my half position with a close below previous bar's low, I'm just hanging in until two things happen essentially. If we get to a 65 RSI level, then I will have if I ever have a close below the 5 EMA, I will get out of everything. Or conversely, if we go up to a 70 RSI level and reject it, I'll sell the half of the remaining shares. And then if that happens, then in the future, if I have a close below a previous bar's low after that, then I'm out of the remaining position. So I know this sounds like a lot of rules if you're new to the channel, but they're really not that hard once you kind of understand it and have some experience with it. But again, this is what I teach in my one-on-one trading course, are all these rules, all the 5 different strategies that I use. So the remaining shares that I have on Caterpillar, doing very nicely, up 9.85%. And again, I just want to bring your attention back to this risk to reward ratio. On the day that I bought, it was right there at the 300. If it would have closed below the 300, I'd simply be out for a very small loss. So I'm risking very small amount for a large reward in this particular case, and that's what profitable trading is all about, everyone. So the remaining shares on Caterpillar up 9.85%. All right, Google, short position. I did short Google here on the 22nd of November. Why? Well, this is what is called an order block over on 1024. It's an up bar move before a change in structure to the downside. And if you're new, I know that probably doesn't make any sense to you, but again, this is one of the strategies that I teach. So here on the 22nd, you're going to find resistance at these order blocks. And do you see how we got here? We got into the order block. I shorted here 138.70. Now this is a short, so everything is opposite. I position size 1% of my capital divided by the value of the 2 ATR. I place my emergency stop 2 ATRs above now. And where's my end of day stop? My end of day stop is simply a close over this high. Very tight stop at 139.36. I place my 1.5 ATR trailing stop level below, and then as it moves down, I take partial profits using the same 0.45 ATR formula that I showed you. So I got short here 138.70. Next bar moved down, took some profits. Next bar, nothing burger. Next bar, nothing burger. Next bar went down enough for me to take some more profits off, and more importantly, we did get to our trailing stop level, which means now in the future, if I have because we're short, if I have a close above a previous bar's close, I will get out of half. Next bar down again, took some more profits off, keep reducing my position size, keep reducing my overall risk, and then Friday was down, but not enough for a profit target. So this particular short trade here, up 5.32%, which is pretty good in this strong market. But these order blocks are very strong, and as when we go through potential when we go through the charts for my potential short trades and long trades next week, order blocks, there are quite a few order blocks very similar to this Google trade. Now to the downside, if we get to a 35 RSI level and we have a close above a 5 EMA, I'll exit the entire position. If it goes to a 30 RSI and rejects it, I'll cover half. And then if I get a close above a previous bar's close after rejecting the 30 RSI, I will exit the entire trade. So Google up, the Google short up 5.23%. Walmart. Walmart is a new position that I took on Friday. Why did I take the trade? Two reasons. Here's the 200-day moving average, very important level of support. During the day, we went under the 200, but closed back above it. That's the key. So I position size, 1% of my capital divided by the value of the 2 ATRs, 532. I place my emergency stop $5.32 below. This is the red line here. Where is my end of day stop? Well, why did I take the trade? Because it went below the 200 and closed back above it. So Monday simply, if we just simply close below this black line, the 200-day moving average, I'm just out of the trade. That's it. Here's the negative third ATR channel, this kind of thicker gray line. During the day, we also went under the negative third and closed over the negative third. So there are your confluences for the entry. Intraday rejection of the 200-day moving average, intraday rejection of the negative third ATR channel, position size properly, place the emergency stop two ATRs below. My end of day stop is just simply a close below the 200-day moving average. And orange line up here, do you remember what that is? That is 1.5 ATRs above my entry. If it gets there, then I will go into trailing stop mode. So this particular trade, I mean, it's up a little bit, but I just bought it right at the end of the, but just to keep score, up 0.04%. Sweet. So next week, Monday, any day, if it closes below this 200, I'm simply out. Is it going to? I don't know. But I know exactly what I'm going to do. If it closes below the 200, I'm simply going to get out for a smaller loss. If it hits my emergency stop, I'm going to get out for a maximum loss of 1%. If it moves up 0.45 ATRs, 0.45 ATRs is $1.20, so 154.34 plus $1.20, whatever that is, that's my first profit target on Monday. Take the first profit target, add it again, there's my second, add it again, there's my third. So do you understand? You don't have to think, oh, what should I do? What should I do? You have a mechanical plan that's based upon good trading principles, which really comes down to position sizing and good risk to reward ratio and confluences of signals. So, okay, just took this on Friday up 0.04%. All right. Now, I have some closed trades that I took. Now, this one was a short that did not work at all. I like the signal, but it just didn't work. And you're going to have a lot of trades that don't work. But the key is, as I mentioned at the beginning of the podcast, if they don't work, you just simply get out. That's it. These other trades that I've been into for days and weeks, they're profitable. So I'm hanging in there. Ones that are not profitable, I get out quick. And I did this on IWM. I did take a short on IWM on the 29th of November. Why? Well, we had a lower high rejection of the 200-day moving average. That was a lot of resistance above. So I position size, placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs below. Where's my end of day stop? Simply a close above the 200. And yeah, we got to close above the 200 all right. Look, here's my emergency stop. I almost hit it. I didn't quite hit it, but I almost hit it for a loss of 3.14%. That's how it goes. And you know, this is a pretty significant, I mean, like I said, only 95% of the time, 5% of the time you get to emergency stop, but this was such a major up bar. But nonetheless, was I in the trade for 2 days because it wasn't profitable? And that's the key. If you're not profitable, your trades should show that you get out very quickly, day or two, usually, if you're wrong. And if you're right, you're staying in for days, if not weeks, if not months. Okay, so the loss on IWM, 3.14%, although I do have another potential short on IWM, and when we go through my potential shorts for next week, I will show you that. So loss of IWM, 3.14%. Last but not least, SPY. I exited the rest of my SPY position on on Monday. So why did I take the trade? Confluence of, I took the trade all the way back here on 10:30. Why did I take the trade? Confluence of signals. Close under the 300 SMA, close over the 300 SMA. Under 30 RSI, over 30 RSI. There's my confluences. Position size, place my emergency stop 2 ATRs below. Where's my end of day stop? Simply a close below the 300. Place my 1.5 trailing stop level up there. Next day moves up, but not enough for profits. Next day moves up, took some profits off. Next day, big move up. I took 2 profits off. I'm in trailing stop mode. Then we just kind of dripped up here. Here on the 9th was my first close below a previous bar's low after reaching trailing stop level. Sold half for, I can't read that, 4.38%. Then we keep moving up, took more profit targets, had another big gap up, took more profit targets on this day. On the 15th, we went above the 70 RSI during the day and closed below. So I sold another half of my remaining position for a gain of 7.7%. Then we kind of moved sideways, had a big up bar here, took more profits. And then here I exit the entire position on the 27th with the first close below a previous bar's low after reaching the 70 RSI level and locked in a gain of 8.62%. So it is higher now. You know, we kind of moved sideways. We didn't do much for 3-4 days. Then we had the big day on Friday, but that's fine. You know, let it go up. Great. And if you're in it, I'm happy for you. But, you know, you want to have a process that tells you when you're done. And this last remaining, this close below previous bar's low after rejecting the 70 RSI just told me to get out, and I got out. So really great trade. Look at the good risk to reward ratio that it offered me with the confluences of signals. This is what trading is about. Staying in when the market's going your way, knowing what you're going to do. 8.62%, so really great. All right, so recap on the dailies. Caterpillar remaining amount up 9.85%. Google, the short, up 5.23%. Walmart just barely took that trade, up 0.04%. IWM, the only loser so far. This one was a loss of 3.14%. And then SPY exited the remaining amount for a gain of 8.62%. Okay, so those are the daily trades. Let's go to the weekly trades. As you know, I like to trade daily. I like to trade weekly. I also like to trade monthly trades as well. And let's get to the, not monthlies. Yes, daily, weekly, monthlies. But now I'm going to show you the weeklies. So these are the weeklies. I took gold all the way back here on the 6th of October. Why? Well, look at the black line. This is the weekly 200 MA. Also look at the negative third ATR channel. So weekly bars close on Friday, so I make my decisions on Friday. And during the week, we went below the 200 week, but we ended up closing above the 200 week. And we also rejected the negative third ATR channel. So I entered long here at 169.70. I position size based upon volatility and my account size. I placed my emergency stop again 2 ATRs below. My end of, I keep saying day, but these are weekly charts. My end of week stop is simply a close below the 200-day moving average. Place my 1.5 ATR trailing stop level here. Next week, just rocketed to the upside. I believe I hit 2 profit targets, took those off, reduced position size. Of course, I'm at 1.5 ATR trailing stop level here, right in the first week. So next week up again, took off more of my position, locked that in, reduced the position size. Next week up again, but no positions. Then we had an inside bar. Then on this week was the first close below a previous bar's low. So I locked in half of the remaining position that I had for a gain of 5.71%. Next week took off again, hit another profit target. Next week up again, but I didn't hit a profit target. And this week here, I hit 3 profit targets. Can you imagine? 3 profit targets. Now look, we're at a 64.05 RSI level. Actually, I should check this. Yeah, not to 65 yet. But if we do get to 65, then the 5 EMA will come into play. It makes it very simple. If I have a close below that 5 EMA, I'm simply out. Alternatively, if we go up and reject the 70 RSI, then I'll take off half. And then if that happens, then after with the first close below previous bar's low, I will get out of the rest. So anyway, the remaining shares that I have on gold really up, massive move, up 11.65%. But again, look back here. Look at my risk to reward ratio. I didn't know this was going to happen, but I did know that if I was wrong, I'd be wrong quickly. But if I was right, that I had a process to follow. So up 11.65% on the remaining shares. XLF. Oh, geez. I've been talking about this trade for eons. And if I've been in a trade for a long time, what does it mean? it means that I've been profitable on the trade. I literally have been in this trade, everyone, since the 24th of March. Let's look at the signals. Here's the 250-day weekly moving average. This is what I was keying off of. During the week, we went below the 250, closed back above. We went below the negative third ATR channel, closed back above. This is what's called a deep dip buy stock trading strategy. Actually, most of the trades that I've been showing you today have been deep dip buy stock trading strategies. And by the way, I have a great course on udemy.com. It's very inexpensive. It's between $12 and $15. I have a link in the description. It's 9.5 hours of video. It's 26 videos, 15 study guides, and I teach you step by step how to trade this strategy. So, confluence of signals with the rejection of the negative third ATR channel, the rejection of the 250-day moving average. My end of week stop is simply a close below the 250. Here is my 1.5 ATR trailing stop level above, and next week moves up, took some profits. Next week, nothing. Next week moved up again, hit some profit targets, got to trailing stop level. Next week moved up, but not enough to do anything. We don't have any closes below the previous bar's low. We move up, we move up, we move up. Here on the 23rd is my first close below a previous bar's low. I locked in half for 6.4% profit. Then we had another monthly up move where I continued to take profits, continued to take profits, continued to take profits. Then we moved down, 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 down. And here I thought we were going to close below the 250 and I'd simply be out of the trade. But again, it rejected it there and held above and kept me in. Next week, up again, massive, took some profits. Next week, nothing. Next week, up again, took more profits. So right now we are at 62.28. If I get to 65 RSI level, then the 5 EMA will come into play. This trade, a monster, up 15.05%. And again, I've been in it since March. What does that tell you? It tells you that it's been a profitable trade. As you can see, when I am wrong, I am usually wrong in a day or two or three, and I am quickly out. And you're going to be wrong, everyone. You're going to be wrong a ton. But you have to have these big moves to pay for all those small losses. That's why you have to have a process that lets these run. Okay? All right. Last trade, Meta. I did get short Meta this week. Oops, sorry. And I'll explain to you why. So with such a strong market, you probably ask, why are you getting short this? Well, I studied one-on-one with Dr. Alexander Elder, and his favorite trading approach with technical analysis are double bottom bullish divergences or double tops with bearish divergences. And he always told me, when you're looking for these divergences, they just need to jump off the screen and grab you by the face. And this is what Meta did to me. Let's take a look at the MACD bar. See how we go green and then red? Look at the high we have here on the 28th. Very huge, strong move up, obviously. And you see all the green that we have here? That is measuring momentum, that we have a very strong move up. Then we pulled back. You see how MACD went red? And then a couple weeks ago, do you see how we are higher here than we are higher here? But do you see how there are no green bars? This is what's called a double top with a bearish divergence. Essentially, it means that it's running out of upward momentum, and the implication is if you're running out of upward momentum, that you are simply going to go down. But you can see here's a high, here's a higher high, here's green, no green. That's called the MACD divergence. Now, there's multiple divergences here. Look here at the RSI. Here's the RSI. You see how high the RSI is here? Here we were higher. The RSI was way over here. That's called a MACD divergence. One more divergence, ATR channels. Look, here's the third, here's the fourth ATR channel. We were higher here. We weren't even to the second ATR channel. So we had MACD divergence, ATR divergence, RSI divergence, all sorts of divergences telling me that this is running out of steam to the upside. Now, Just because that happens, it doesn't mean that you just rush into the trade. That's big picture context that you have these bearish divergences, which is implying that it's going to go down. But you still need a signal to get you into the trade. Well, I did get that signal this week. This is called the V2. Bar 1, bar 2 goes above bar 1's high, bar 3 goes below bar 1's close. I did enter a little early on this. I entered here on the 29th when it made the weekly go below the close of bar 1. You know, you can wait for the end of the bar. You can do it intra-bar. There's pluses and minuses to each. So I did get short here at 334.60. I position sized correctly based upon how I showed you early in the podcast. I placed my emergency stop 2 ATRs above because I'm short. I placed my 1.5 ATR trailing stop level here below. And then the only thing left is where is the end of week stop on this one? Well, on a V2, it's a close above halfway of the washout bar. This is the orange line here. And if you would like to learn more about V1s and V2s, go to my YouTube channel. I have a great video there that talks about V1s, V2s. I use them all the time in my trading. They really help to separate what trade is better than decide which trade is better than another trade, because it's I always talk about confluences, combinations of signals. V1s, V2s are definitely legit there. So this particular short trade from entry to current price is up 3.05%. And again, if it gets to my 1.5 ATR trailing stop level here, then I go into trailing stop mode. Simply next week, if it closed above halfway of that the washout bar, I would simply get out. And then, of course, I have my trailing stop level above. So recap on the weeklies, all really good. Gold remaining shares up 11.65%. XLF remaining shares up 15.05%. Meta current shares up 3.05%. Okay, everybody. So before we start looking at the potential trades for next week, I want to do a little bit on trader psychology. This is from Steve Burns, good friend of mine, mentor, coach that I had for a couple years. Unbelievably great trader, great author. He has so many books. You can find them on Amazon. Just look up Steve Byrne books. And I've learned so much from this man. Just want to give him my gratitude. And a lot of what I'm teaching you here today with the deep dip buys, I did learn from Steve. So he has some great books. Let's see what Steve has to say here. Remember, in trading, patience is not just a virtue, it is your edge. Yes, generally, big picture, patience is a virtue, but in trading, it is not just a virtue. It is your edge, and you need an edge in trading. And people talk, what's an edge? Well, an edge is basically mathematical situation where one thing happens more than another. If this happens, or in other words, if a 200-day moving average is rejected with a confluence of signals, more times than not, it's going to head up. Sometimes it's going to head down, but more times than not, it's going to head up. Just like in Las Vegas, whether you're playing roulette or blackjack or craps or baccarat, they have a mathematical edge in every hand they play. Do they win every hand? Well, of course not. You've been to Vegas, you've played some hands, you've won some hands. Do they freak out when you lose a couple hands? No, because they know over the long run they are going to win more than they are going to lose. And it's the same with trading. If you look for confluences, combination of indicators lining up at important major levels, they're not always going to work, but they're going to work more than they don't work. And therefore, that is your mathematical edge. But why is patience an edge? Because you have to wait for them to get to those levels. Patience is such a virtue in trading. Being patient, waiting for it to get there, waiting for the price to get to the level that you want where your edge comes into play. So there is an edge in the confluences, combinations of indicators, but the psychological edge is for you to be patient enough for them to get there. Make sense? So that's why when we turn to the potential trades for next week, I am not in them yet. I am being patient, waiting for them to get there. If they get there, yes, I'll consider taking them. But until they get there, I'm going to sit on my hands and do nothing. Make sense? All right. Thanks, Steve. Appreciate that. You can follow Steve over on X at @SJosephBurns, and I really highly recommend that you do. All right. Let's see here. All right, here we go. These are the potentials for next week, starting with the daily. And this is Advanced Micro Devices, AMD. So, I use the ICT method a lot, looking for fair value gaps, structure changes, and so forth. Again, something that I teach in my one-on-one courses, but semiconductors have not been as strong as the rest of the market. You're seeing some rotation out of tech. Qs are definitely not as strong as the SPY, IWM, diamonds. Money is changing from the high techs into the more traditional cyclical companies. So here on AMD, here's a level of liquidity. We ran the level of liquidity, and then here's your first low after running the level of liquidity here, and we broke it to the downside. This, from an ICT perspective, shows that we are now in a bearish market structure. And when you have a bearish when you have a bearish market structure change, you look for what's called fair value gaps. And this high here, the low, I have the red line, and then the third bar here, the high, I have the green line. So technically, it is legitimate to short anywhere in between this gap with your stop with a close above the most recent high there. For me, I tend to phase into these gaps, but for the purpose of this podcast, just to make it simple, I will only take this trade, or potentially consider taking this trade next week, if we get it up to the top gap, which is 123.40. So if next week, anytime next week, we do get to 123.40, that will be the top of the fair value gap. I will consider shorting AMD there, with my end of day stop being just a close above that high, and of course I'll have my emergency stop at the top here. Okay, so I hope that makes sense. Here's the fair value gap from 121.50 up to 123.40. Technically, anywhere in here is shortable, but like I said, for the purposes of this podcast, just to be specific, if we do get to 123.40, I will consider taking a short there on AMD because of the run of liquidity, the change in market structure, with the end of day stop being a close above that most recent high there of 125.72. Anheuser-Busch, Budweiser. Boy, look at this run. This is unbelievable. All right. What am I looking for here? Okay, just like I showed you on the short on Google, order blocks. This is an order block. Way back here, January, February, March, in May. We had a high. We ran that liquidity. This is the highest up bar before market structure change here. See, this was a market structure as well. High, ran it, boom, yes, went down. So this order block will be very difficult to get over. Not saying it can't be done, but if Budweiser gets anywhere on the order block, it's anywhere. On those fair value gaps, it's the high of the fair value gap. But anywhere between 64.80 and 66.32. So next week, if we do get into that level here, anywhere in here, I will definitely consider taking a short. Where will my end of day stop be? Simply be a close above the high of that order block. So anywhere right in here between 64.80 and 66.32 is where I will consider taking a short. And by the way, I mention this each podcast, but listen, what do I have? 6 symbols here. It's possible that all 6 of these will trigger on the same day. Does that mean I will enter all 6? No. I only will take one trade per day, and I have to narrow it down to what the best one is. Even if they all trigger at the same time, there's still going to be one that's better than the other. And what does that mean? Well, look, if Budweiser, for some reason, gets into this order block, but also has a V1, that's better than something else that just went into the order block and that's it. And so it's very important that you have to narrow, you have to get out your fine-tooth comb, and you have to narrow down the best trade. And again, this is an important thing that I teach in my lesson, in my one-on-one courses, is how to pick from 5 different stocks or 5 different markets that triggered an entry signal. It comes down to how many combinations, confluences of signals happen. Did one have a V2 and one didn't? I picked the one with the V1 or the V2. Relative strength of the market compared to the rest of the market. That's very important as well. Looking at higher time frames. You know, if I get a signal, if all of these on the daily trigger on Monday, and I'm trying to decide which one to pick, I would switch to the weekly. If I'm trading dailies, I would switch to the weeklies and look what's going on in the weekly. Are there confluences, rejections of levels on the weekly as well? So really, when you get in, it's the devils are in the details, looking and trying to pick which one is the best setup. Basically, which one gets the best report card on signals, multiple time frames, relative strength. Okay, so yeah, Budweiser, very clear order block here between 64.80 and 66.32. If we get into this area next week, I will definitely consider shorting Budweiser with a close above the order block here at 66.32 as my end of day stop. IBB. IBB, big day up. Well, order block over here on the 11th of October. Here's the highest up bar before a structure change break to the downside. It's almost there. You see it? It's almost there. So Monday, if we continue to move up and we are in this order block, I will consider shorting IBB with the close above this high here of 124.13. But again, I want to look for confluences. And even if this gets here, I may not take it. I may take something else if it has a better setup. Russell 2000. All right, that's the one that I got whooped up on Friday. And so let's clear the charts here because there are some other potentials here that I'm looking at on IWM. Look, order block. So the order block here, it's higher. The low is 184.24. 184.24 is the bottom of the order block, and then high 186.07 is the high of the order block. And you can see we are already in this order block here. So for me, I had to get out of my other position. But next week, if we test and reject the high of 186.07 here, I will consider getting short IWM again. But you can see it's already in the order block, but my previous signal told me to get out. So I could have stayed in and justified staying in and going, well, if it gets above here, then I'll get out. But I wanted to do the right thing. It closed above the 200. I just said, okay, I'm out. But next week, if we get to that order block level there and reject, same with Google, then I would get out of the trade. I'm sorry, I would enter the short position there. Pfizer. Okay. You have heard me talk about island reversals and abandoned babies. One of my absolute favorite new signals. And an abandoned baby, well, here, let me show you an example. India. I don't think it could be more perfect than this. An abandoned baby is when we have a gap up and an immediate gap down 1 bar. You see how it's kind of left out here in space? That is a bearish signal. Was it accurate? I would say so. Here, an abandoned baby, a bullish abandoned baby, where we gap down and then we gap up. Look at that. Think we nailed the top? I'm sorry, think we nailed the bottom? I would say so. So this abandoned baby absolutely nailed the top, absolutely nailed the bottom. So why am I bringing this up? Because I am talking about Pfizer. So Pfizer, one of their drugs they were working on, they decided not to go forward with it, and we had the gap down. So obviously gap down. So next week, I guess on Monday, if we have a gap up, for some reason, this will be an abandoned baby, a bullish abandoned baby. And if it does, that very likely could be the low. Not sure, but it very likely could be the low. Or we may go sideways for a couple days and then have a big gap up. That would be what's called an island reversal. Abandoned baby is 1 bar, island reversal several bars, and I do have a video on YouTube about abandoned babies and island reversals, so feel free to go check that out. You can find it on my lessons playlist. So but for next week, as far as Pfizer, for some reason, if Monday we gap up, I would get long Pfizer with the abandoned baby. All right. And again, I teach these in my one-on-one courses as well. Last but not least, SSO on the daily. SSO is double leveraged Dow and double leveraged S&P, excuse me. Here we have a high. We ran the level. We broke structure. The fair value gap here is from 61.10 to 59.88. We are in it right now, but I want to see a rejection or a touch of the top of the order gap. One, because it makes my risk to reward ratio much better. Where would my end of day stop be? Just simply a close above the pivot high that happened right before the fair value gap. So very likely I could take this trade next week if we get to 61.10, all right, and a good fair value gap. So real quick recap, I am considering shorting AMD next week if we get to the high of the fair value gap at 123.40. I am considering shorting Budweiser anywhere between 64.80, 66.32. IBB, I'm considering shorting IBB anywhere between 122.80 and 124.10. Russell 2000, considering shorting Russell 2000 if we get up to 186.07. Pfizer next week, if we have an abandoned baby or island reversal, I would consider getting long Pfizer. And then last but not least, SSO, if we get to 61.10, considering shorting there. And again, they may all happen on the same day, but I would narrow it down to the very best one, the one that has the best confluences of signals, that looks best on the multiple time frames, and then also relative strength to the rest of the market. So those are the potential dailies for next week. And then weeklies, got a few of those too, mainly to the short side. Okay, here's Adobe, ADBE, level of liquidity. We ran the level of liquidity. We changed market structure to the downside. Fair value, order block here between 655.19 and 699.50 on the weekly. So next week, at the end of the week, if we are inside this fair value gap, I will consider shorting, with the end of week stop being the close above the high back there before the high of the order block. So give me a good risk to reward ratio. So considering that. Berkshire Hathaway, again, level of liquidity. We ran the level. We changed market structure. The order block here is between 364.40 and 370. right in here. You can see not last week, but the week before, we got right up to it before we pulled back. But consider a short. I'm considering a short on Berkshire Hathaway, BRKB between 364.40 and 370.90. Morgan Stanley, potential long trade if we pull back and retest that 200. That's about it. We may pull back. Will give us a higher low rejection of the 200, then we may continue up, but definitely want to have something long here. But if and only if we bounce or intra-week reject at the 200. Qs. Okay. Fair value gap here between 390.20 and 397. Again, if and only if we get to the top of that fair value gap at 397, will I consider getting short Qs? Tesla. If we pull back, get a higher low test of that 200, I will consider getting long. And VIX. VIX did not trigger, but it's very interesting with VIX. VIX was down 1.21% last week while the market just melted up. That's something to take notice of, everyone. It really is. If you would have told me a couple weeks ago that we had this large of a move up, I would think VIX would be down 3, 4, 5%, and it's only down 1.21%. So to me, this is showing me that we are most likely near at least a short-term top in the market based upon what the VIX is doing. And as I've just shown you for the last half hour, all these fair value gaps and order blocks were getting up to the upside. So VIX is hanging in there very well. We have a double bottom with a bullish divergence, extremely bullish. We have RSI divergences, we have ATR divergences, and we also have a wolf wave. I don't know if you remember, but I was telling you about wolf waves all the way back before this market had its big rally, and I just want to show you here on the Qs. If you remember, here at the bottom I said we have a wolf wave. 0.1, 0.2, 0.3, 0.4, 0.5 is the buy area on a wolf wave. Was it right? It certainly was. And where is the expected move? Right here. You take the slope of that line here, and it should get to there. And it got to there. Pretty amazing, right? Well, keeping that in mind, everyone, let's go back to VIX on the weekly. 0.1, 0.2, 0.3, 0.4, not quite to 0.5. But if we get to 0.5, very likely VIX, if the wolf wave is correct, doesn't have to be, but a lot of times it is, will head back up into this range, which would kind of put it in the high 20s, low 30 range. Right now it's 1721. What do you think is going to happen to the market if VIX is up here? Yeah, market's going to be way down if VIX is up here, clearly. So I'm not saying that's going to happen, but I'm just saying from a technical analysis standpoint, we have lower low here than we are here. There's not even any red. We have RSI, even though we're lower here, is higher than here when we were higher over here. Here we were at the negative third ATR channel. Here we're only at the second ATR channel. So we have a trifecta of bullish divergences on the VIX. The implication to me, it's going to go up. Well, do I buy now? I wait for the trigger. Look, we're at 29.39. A legitimate entry signal. If we would have closed over 30 on Friday, I would have gotten long VIX with my end of week stop being simply a close back below 30 RSI. But this chart to me is very interesting. All the divergences, MACD divergences, ATR divergences, RSI divergences, almost to the bottom of the wolf wave. So this makes a lot of sense to me. And there was a lot of volume in the VIX. It went down 1.21% when the market just screamed up. So I'm definitely waiting for either a 0.5 down here on the VIX for the wolf wave, or a close over the 30 RSI just for a simple deep dip buy with all the divergences. So real quick, Adobe, just a real quick recap. Oh man. Looking for potential short between 655.19 and 699.50, anywhere in this order block. Berkshire Hathaway, looking for potential short in the order block anywhere between 364.40 and 370.90. Morgan Stanley, potential long if we pull back to the 200-day moving average. Q's, looking for a potential short if we get to the top of the fair value gap, 397. Tesla, long, looking for potential of a pullback to the 200-week moving average. And VIX, of course, I just went over, looking for either getting to the bottom of this wolf wave and or simply a close above the 30 RSI. But again, everyone, it's important. They may all trigger at the same time. You have to pick the one that has the most confluences of signals. And again, that is what I teach in my one-on-one course. You know, I've taught so many people around the world, from beginner all the way up to expert. The course is 15 hours. Each session is 3 hours, and then we do 5 sessions. So 5 sessions of 3 hours. That gives you your 15. I teach you all of the different trading approaches that I use. We do all sorts of simulations. I let you drive. You know, once I've taught you the lesson, then we will pick a random market, we'll pick a random time frame, and then you will have to tell me, are you doing anything on this bar? No. Next bar, we'll take a look at the next bar. And then at the very end, you will be doing all the trading. I will just be sitting back and going, yes, you're right, or no, that wasn't right, and this is why, and so forth. But it's not just teaching you, it's we trade. We trade, we trade, we trade. We look at all sorts of different markets, and you incorporate everything that I've taught you. So if you're interested in doing this, it does cost $1,750, but I tell you what, it is really a great value. You're going to learn a skill that you can use the rest of your life, and you're going to learn from someone who has traded over 28 years now, have seen all sorts of different markets. So if you're interested, just send me an email. I also mentioned my Udemy course. The link's in the description here. All you have to do is click on that. It's between $12 and $15, and it's a great video course. It's very inexpensive, between $12 and $15. I highly recommend you that if you want to get started and you're not able financially to do the one-on-one, start with that. It's a really good place to start. I always like to leave off the podcast, everyone, with try to go out and do something nice for another human being today. It would really make the world a better place if you could do that. If you could also have it in your heart to go out and do something nice for an animal. You know, animals appreciate acts of kindness just like we do. You know, I think the world could use a lot of improvement, and if we all did one nice thing for another human being each day, one nice thing for an animal each day, how could it not help, right? How could it not help? So I appreciate you being here. If you could hit the thumbs up button, I should say, if you found something valuable here, all I ask is that you'd hit the thumbs up button, help out the channel a little bit, let YouTube know that there's some valuable content here. But I really appreciate you all spending the time here. I hope it was helpful. I hope you have a nice rest of your weekend. I'm going to go out and shovel snow now because we had a huge amount of snow because I live in Utah. But thanks so much for being here, and God willing, I will see you next week, and we will see what happens. But be careful this week. Be careful every week, but be careful. You know, the market is in a bit of a frenzy, and there's a lot of FOMO going on. There's margin calls to the upside. It's probably not the best place to start taking a large position in here, right? All I've been talking is about these shorting opportunities for me, right? I'm certainly not thinking about getting long at these levels. So be very, very careful. Don't get sucked into the mania. Okay, my best words of wisdom there. But do what you feel right. That's just my own personal opinion. All right, on the way out, I have to run the U.S. legal disclaimer. Thanks so much, everyone, for spending your time with me, and have a good rest of the weekend. Bye-bye.
U.S. government required disclaimer. Stock forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.